Hello, my name's Trevor Shaw and I'm a tax director with TC Group. Today, I'm going to be talking about how you maximize your cash on the sale of your business. Now, I talk about maximizing the cash rather than reducing the tax liability because my job is to help you to maximize the amount of cash you get. And what I mean by that is if we can sell your business for a bit more and you have to pay a bit more tax, but provided you've got more cash left, then that's a good result for you, rather than trying to minimize the tax liability. And one of the areas we've helped a lot of businesses in the built environment area is with incentivizing key employees to be retained and work hard in the business. Now, when you look at your business, you will know that there are key people that are vital to the long-term success of your business, but you may be concerned that they would leave the business. So one of the things we can do is offer them equity in the business, a stake in the business, so that when you come to sell, they get a proportion of the sale proceeds. Now, that may sound like you're giving up part of your business, but if they were to leave, your business could be worth less than it would otherwise have been. So without them, it might be worth 100, but with them, it might be worth 120. Now, if you'd given them 10% of the business and they stayed, your 90% of 120 is 108, which is more than the 100. So although you may end up paying more tax on that sale, what we are doing is we're maximizing the amount of cash that you will get after tax. Now, how can you give away 10% of the company? And it doesn't have to be 10%, it can be an amount that suits you. But let's say you want to give away a percentage to employees, well, we can use a share option arrangement. And that means that they have the right to buy shares at a price agreed today just before the sale. And when you sell the company, they buy their shares and sell them to the purchaser. And that actually means that they get a cash receipt at that time. And that cash receipt will be subject to capital gains tax, which at the moment is 24%, significantly less than paying income tax at 40 or 45% on what could be quite a significant sum for them and could be life-changing. So what have we done? We've looked at a way to try and keep as much money for you while looking after your key employees, so everybody benefits. Now, if we're looking at your position on the sale of the business, then you will be subject to capital gains tax as well. And as I said, that's currently 24%. However, there is a relief called business asset disposal relief, and that is available to business owners who meet certain criteria. And that can reduce the tax rate that you pay on the sale of your shares down to 18% or less, depending on the date of sale. Now, there are a number of criteria that need to be met to be able to achieve this benefit, and it is important to make sure that those are met, and early planning is vital in these cases. I've come across a few cases where people thought they were going to get this relief, and they haven't got it because they hadn't planned in advance to make sure they comply with the rules. So that's a very good scheme that could be taken advantage of for your business, and works really well if you're selling to management of the business or if you're selling to a third party or somebody in the trade. If you don't wish to sell to a third party, but you'd really like to sell to the employees of the group, we can help you structure a sale to an employee ownership trust. And that basically means that the employees ultimately have the benefit of the ownership of the company. But your sale to the company can be achieved tax-free. There are a lot of criteria, again, to obtain this very generous tax relief. And so early planning, again, is required to make sure that is met. And for not all businesses, is it the right answer? For some businesses, it's a very poor result for the business going forward. So it is important to make sure you look at the right exit strategy for you.